Hey everyone, I hope you all had a great week in the markets. In this video, I'm going to do a top line review of how my portfolio has been doing this last week. Going to go through some stocks that I've been buying and adding to in the market, and then also talk about some stocks that I've been watching in the market over this last week as well. So, going to jump right into it. As you can see, the portfolio is currently up to about $216,000 here. We're going to start on the Canadian side. So my Canadian portfolio was dipping a lot, but in the last week, it actually went up a nice amount, up 2% on the week, about $2,200. You can see here in the last 3 months, I'm still down. In the last 1 year, the portfolio is actually now in the green again. And we've done a bit better longer term, up about $6,000 on this side of the portfolio. Going into some of the stocks that I have been adding to in my portfolio, or just some comments about my portfolio. First one is just cash is a high interest cash ETF where you get just pretty much interest on a monthly basis, pays about 5% annually here. And this is one that I haven't been adding to, but it's been steadily going along as a $16,000-$17,000 position in my account. As you can see, I really do still like having this on the sides in case the market absolutely crashes or something like that. I have a big cash pile here to pull from and invest in. So that's one that I was thinking throughout the month, hey, should I take some money from this, invest in some of the stocks we were about to talk about? I ultimately decided, no, I want to keep a big cash position in case the market really goes down and turns sideways. The first stock that I have been adding to in this week has been Jameson Wellness. So this is one that I mentioned last week. I was starting a position in, I think I had about 20 shares. I built it up to now 55 shares, looking to get it in this next week, as long as it stays at these $25, $26 levels, looking to get it closer to 100 shares, and then we'll decide what to do with it from there. They're expected to do about $1.60 in EPS, so their multiple here is like a 16 times, something like that. And as I look at their performance here, currently trading at $1 billion. They have free cash flows of around $80 million, I believe. And their dividend yield, which they've increased their dividend every single year since going public, is at 2.7%. So it's a decent starting yield. Really hard to get this kind of CPG exposure on the TSX, where you don't have to pay a foreign exchange fee. You don't have to worry about currency risk. You don't have to pay withstanding taxes to the U.S. government, since lots of the other companies that play in these types of spaces trade in the US. So I just like the setup of having this company in Canada, at least on the TSX. And then in addition to that, their valuation is just significantly lower than lots of their peers or similar types of companies, despite the fact I actually think they probably have more tailwinds at their back in terms of category growth and whatnot in the areas that they play in. So that's why I'm buying this one. Obviously, in the grand scheme of things, still a very small part of the portfolio, just $1,400, so under 1%. But looking to continue building it up, and hopefully, as I am building it up, more earnings reports are coming out every quarter, and I can kind of reaffirm my thoughts on the company and their performance to make myself have a bit higher conviction in making this like a $5,000 or $10,000 position. The second stock that I think I just added a tiny bit to this week was the KEG Royalty Income Fund. This one has been going down in the last month, down 7%. They did report earnings, I believe, a couple weeks ago, and they weren't great. I think their dollars were around flat, and they have taken a lot of pricing, which means that their volume was down pretty considerably. So that's one thing to be mindful of. I think last year in their base, it was lots of people going out because of restrictions coming off, and that being really the first summer that people weren't as shy or skittish around the pandemic and getting sick. So I think they did have a big base, but this one's currently trading over an 8% dividend yield, gets paid out monthly. I think it's a pretty stable company, stable industry for the most part. Obviously, if we go into a recession or something like that, KEG Royalty will likely get a pretty decent hit, just because of the customers they serve and the price range that they are in, and the fact that it's a sit-down restaurant. Lots of people will cook at home, do more takeout, quick service stuff. So that's fine. I acknowledge that. In the grand scheme of things, once again, pretty small position, only 100 shares. But this one's paying me about $10 a month in dividends in my Wealthsimple account here. So this is one that I just topped up recently, and it's not one that I want to build up into a huge position in this account. But if it keeps trending down, and I start getting to like an 8.5% yield, 9% yield, the risk reward continues to get adjusted. So at some point, would I add more to this? Sure. But it's really just looking at what that yield is and assuming I feel confident that their dividend distributions will maintain at the value they are today. And then I'll just average down and continue to get a better yield on this company. Okay, continuing down through my Canadian portfolio here. One of my bigger focuses has been in my diversification of ETFs. So XIC is a stock that I've been buying. It is essentially a TSX market ETF. You see here they pay a dividend of about 3.1%, paid out quarterly. They also have a market cap of $9 billion, so lots of liquidity in this ETF. They are a very popular ETF with Canadian investors, or just investors in general trying to get exposure to the Canadian market at large, because they have a very low management fee, about 5 basis points. You can see it hasn't been too volatile, even as I go back 5 years. Well, it's been volatile, but it's really mimicked the TSX. So this is just something, as I'm over-indexed in banks, I'm over-indexed in real estate, royalty funds, restaurant space. I just want a position that I can confidently allocate capital to, that I get a 3% dividend yield, and kind of helps cover the bases that I'm not in my portfolio within the Canadian market, like energy, like retail, some other areas. So that's really the idea here. Just a stock that I can put money into, an ETF I can put money into, low management fee, pays me a 3% yield, helps me sleep better at night knowing that I'm covering all my bases, even some industries and some sectors that I don't know as well, don't feel comfortable owning individual stocks in, but diversified in all of those spaces. So then if one of them does crash, it's not a tremendously big deal for this ETF like it would be if I held an Enbridge or a pipeline or something like that. And other than that, some stocks that I am looking at. Actually, I'll go to my US account first and show you what I've been buying there, and then I'll do stocks I've been looking at and watching at the end. So my US account up 13% in the last week here. Much different story, actually down 1% in the last week. So a complete switcheroo versus my Canadian account. Looking at stocks I've been buying, Coca-Cola has been one I have been buying. You see here in the last month, this one's down about 5%. No meaningful news has come out. So this is when I built up to 175 shares in this account. So probably bought another 20, 25 shares in the last week. Now we're over $10,000 in total value. My average share price is about $60. So I can still continue to average down, and I may continue averaging down in this week ahead if it continues to trend down. Currently, Coca-Cola is trading at a $250 billion market cap, 24 times PE, and I think this dividend yield is not accurate. It looks a bit high. Maybe it's Canadianized in the data. It's pulling over a U.S. share price. But I think the dividend yield's at about 3.2% right now. So pretty decent yield for a company, yield for a company that increases their dividend every year. Pretty stable business. This was one, as we were talking about Jameson earlier. Jameson's trading at 16 times earnings, and they're in like a wellness space with vitamins that should grow globally, grow in big markets like North America. This is a beverage company, lots of their businesses in sodas and things like that, and they're trading at 24 times. So that just, not that I don't like Coca-Cola, I do own it, obviously, and I own much more of it than Jameson. But just as I look at Jameson, in terms of the opportunity on multiple expansion on category and revenue growth, I feel like the risk reward there is really strong. But Coca-Cola is another one that I do own. I don't think it's one that I'm going to make a ton of money on, but I will get my 3% dividend yield. I hope I do get some modest capital appreciation over time. And it's just a very developed, very solid company, very profitable. And I like investing in those types of companies with the majority of my portfolio, just to make sure it's defensive and even in an economy that starts to go down, I don't think people are going to be necessarily buying less drinks and consuming less beverages. So I think it's a defensible stock to own, and I'll get a decent return. Nothing crazy, but I think I'll do decent with it over time. The other stock that I own, and one of them that has been going down, is Realty Income. So Realty Income here, if I go over the last month, down 5% on this one here. I think if I go over the last 3 months, it's more like 12%. So this stock has had a tough go. I actually bought some more shares this week, so I'm up to 165 shares of this one, down 10% all time. So my average price is, again, around $60, similar to Coca-Cola. Realty Income is paying a 5.5% dividend yield. They make about $4 of funds from operations. So if I multiply that out, they're trading just under 14 times funds from operation here. And they have really great assets in their portfolio, triple net leases, so lots of cash flow, very diversified across the U.S., both in terms of states that they play in, as well as tenants that they have. They just bought into the Bellagio in Las Vegas, which was a pretty cool kind of flagship property and investment that they bought into, but they're primarily a retail company. Also expanded to Europe recently, about 10% of the businesses in the UK, couple percent in Italy and Spain. So I love the diversification of this. The valuation's getting a bit more enticing here at around 13 to 14 times funds from operations. So this is one I'm going to continue to keep an eye out. I'm going to continue considering adding to it in this account. Obviously, with high-yielding U.S. stocks, I do have to pay withholding tax. I always call it withstanding tax, I think, to the U.S. Of about 15% of the total yield, which sucks when we're dealing with these high yielders like AT&T or Realty Income. I think the way to get around that is if you hold them in your RSP, the U.S. government actually realizes RSPs as an investment vehicle. So they don't charge that tax because they realize it as a tax-free account. But in your TFSA, they don't realize that one. So that one you would still have to pay the taxes, the incremental taxes to the U.S. government on. So just a heads up on that dynamic when you're buying a stock like Realty Income Corp. Continuing down on the U.S. side, another stock similar to my Canadian comment on XIC. I've been buying more VXUS, which is a total international stock ETF minus the US. See here, I put about $1,400 in it. So last week, I think I just had like 5 or 6 shares. So have really been trying to ramp this one up over the last week. You can kind of see over the last 5 years, this one hasn't moved too much. And as we look at the dividend on it, it's a similar 3% starting yield, but a much bigger market cap. So tons of liquidity on this one. $58 billion market cap. So they have lots of people invested in this ETF, which is always a plus for whenever you want to buy or sell. You don't have to really pay too much of a premium. But this ETF really covers every single market in the world except for the US. So I'm getting huge geographical diversification. It has China, it has Australia, it has India, it has Latin America, et cetera, et cetera, et cetera. Japan, all the big markets, all the small markets like the European countries, Belgium, Netherlands, everything is in this ETF. So I'm getting equities from all over the world, given obviously as you look at the rest of my portfolio, very heavy centered around Canada, around the US. So this is just giving me that investment in that exposure to new markets that are really hard to get direct ownership of or direct exposure to when you sit in Canada, even when you sit in the US. So this is kind of my play into those markets. I'd be willing to make this a very big position. So going to continue building it out, have some more exposure on that side of the economy, and we'll see how it develops over time. Historically, the markets outside of the US have underperformed. So I acknowledge that this may underperform long term. But I do like having the diversification, and I'm willing to take, modestly lower returns if it means I'm getting more diversification globally throughout my portfolio. And also I do like the 3% dividend yield that no matter what happens, I'll be getting with the Vanguard Total International Stock ETF, VXUS. Okay, going into a new stock that I added, and this is a bit of a trade. We'll see how it works out. It's just a company I'm interested in. So I added 4 shares of the TKO Group on their merger. This company is actually the combination of WWE and the UFC. I always thought the UFC was a great asset to invest in. They've been growing really quickly. They have huge pay-per-views. They have so the event side of the business, the streaming rights are worth a ton. They own the entire league. It's not like um, a sports league like the MLB or NFL where there's team owners that own components. It's really just them running the whole show and getting um, all of the benefits of that, and they can make decisions a lot more smoothly and less red tape that way. It's also a very global sport, and WWE is becoming increasingly global as well. So I really bought this one because I wanted more direct exposure or the opportunity to have more direct exposure to the UFC. They used to be owned by Endeavor Group, which have a ton of other things going on. Now this company here, TKO Group, is just UFC and WWE. It is valued here in the high teens billions, so definitely a high valuation. That's why I only have about 4 shares in it. The other thing about TKO Group is they're actually paying out a special dividend of almost $4 a share to investors next week. So hopefully I'm still in this one at that point, unless the stock goes up a lot, and I'll get that. Obviously, it's just going to come out of the stock price. The stock price will probably go down $4 the following Monday, but I found that to be an interesting thing that they're doing in order to get some capital into their shareholders' hands. I think Vince McMahon, who was one of the biggest owners of WWE shares, wanted some liquidity, so that's why they did it. And then Endeavor is going to get paid a nice chunk too for them to invest in their other businesses. So they're just kind of taking some cash off the table by doing that $4 dividend. But that's just something to be aware of if you have bought in or you do buy in to this company. If the stock price goes down, it's likely just going to come back to you via a dividend in the coming few weeks. A couple things that I like about this space in general is just the combined media rights of being able to leverage UFC and WWE together. I think there's lots of synergies there, as well as streaming exclusivity and streaming rights for these brands and these entertainment assets are very high in terms of potential as well. So I like the synergies that'll come with this. There can also be a lot of crossovers between UFC into WWE, which I think is really cool. We've seen it before, mostly on the end of people's careers, like Brock Lesnar, Ronda Rousey, stuff like that, crossing over, and they've always been big names, brought about a lot of buzz and elevated ratings and TV rights for the WWE. So not to go too much into it, but I do think it's a lot of potential in this company. I think it's very expensively valued. I think they said they're going to do about $1 billion in EBITDA, but they're trading closer to 20, so 20 times. With that being said, they have a big media rights deal expiring later this year into next year, and based off of what the NBA, NFL, NHL has been re-signing their media rights for, it's like 2 times, 3 times the value of the prior deals. I think they'll get a nice little raise too. So it's a bit hard to say what the real PE and EBITDA multiple on this company is with that huge amount of revenue and profit that is kind of just hanging over their heads. In lots of sense, the media is like 70% of the profitability of these companies here. So this is just a bit of a trade, and if when everything actualizes, I think it's a decent multiple, decent value. I may hold on to it. Probably won't make it into a big position. If this stock went up to $110 next week, I'd probably just sell out. But it is one that I've just been playing around with a bit in my portfolio that I thought I'd share with you guys. On the stocks that I am watching and considering investing in, SPGI, which is S&P Global, is a stock that I added a couple weeks ago. Currently I have 5 shares. I was actually hoping to get this up this week to more exposure, more shares, but they were running up closer to $400. So I decided to allocate like my money in other places that we just went through: Coca-Cola, Realty Income, Jameson, stocks that were down throughout the week. I didn't want to buy S&P Global, which was going up when there was other stocks I like going down. But this one has corrected a bit, most notably on Friday, went down 2% here. Now I'm back to about flat on it. And I really do like the business here. Just looking at their ratios first. They have a forward PE in the high 20s. They have a dividend yield almost at 1%. But this company just has a lot of recurring revenue. Their ratings business is essentially a duopoly with Moody's, and every company really has to leverage one of the two of them when they're selling debt or selling other financial securities to the market. In addition to that, I like their index business, and I'm starting to learn a bit more about their market data business, which is really attractive as well. It has lots of recurring income streams there as well. So I think this is a great business. I think it'll grow with time. Definitely paying up for it with the high 20s multiple. But I don't have a lot of dividend growth stocks in my portfolio versus my high yielding royalty funds, my covered call ETFs and whatnot. So I think this is going to be one that I build out a bit more and add it to that portfolio of dividend growth stocks that I own in my portfolio. Going over to some other stocks that I've been watching in my account, I was looking at Microsoft, but this one's just gotten so tough to add to at these levels given where it's come from. I was buying a handful of Microsoft shares down there in the 220s, 230s just a couple months ago, it feels like, more like 9 months ago. Up 33% in this position here. Pays me similar to S&P Global, just about a 0.8% dividend. And I believe they were trading at, or they're expected to do around $11 of EPS. So they're going to, looks like they're trading at about a 30 times multiple. So also similar to S&P Global. But I already have a pretty big position in Microsoft. So unless it experiences a bit of a correction or weakness or has just a really good earnings report that I like, this is one that will probably stay on the watch list in terms of stocks I'm looking to add to. Going over to the Canadian side, some stocks that I've been looking at over here. CN Rail had a huge comeback this week. It was down in the 140s, which it hasn't been down in the 140s for a while. So I was actually looking at building another 5-10 shares in the CN Rail. Currently have 85 in this portfolio. But then you see this huge jump here from 147 to 157 in just a day or two. So obviously some news broke. I think I was listening to an investor call, and it looks like they announced or just made comment that their fourth quarter volume-wise was going to be better than the third quarter in terms of indexes versus a year ago, and that this has kind of hit the bottom is what they were calling in terms of volume decline. So I think that may have been it. It may have been other announcements too, but that's one I ultimately didn't end up adding to because of that late appreciation in the stock price on the second half of the week. Continuing to go down, Restaurant Brands International here is one that I was watching closely. It tickled the $90 mark here earlier in the week, $90.20. And this is one that is going to do about $4 $5 of earnings next year. So at these levels, we're trading just under 20 times next year's earnings. And if it gets into the 80s, it may be one at 18 times, 17 and a half times earnings that I decide I want more exposure into the stock. So going to continue to watch this one. I may end up adding to this one next week or the week after, depending on where the stock price goes and what other opportunities there are in my portfolio and in the market. But this one so far I've been doing really well on. My average price is all the way down at $75. So up 23%, have over $10,000 in it already. And it does pay me a nice little dividend yield of 3 to 4%. For those of you who don't know, Restaurant Brands International, also goes by RBI sometimes, owns the fast food chains Burger King, Popeyes, Firehouse Subs, and Tim Hortons. So well diversified. They have a lot of exposure to Canada because of Tim Hortons, but some of those other brands, especially Burger King, has great global penetration. And then lastly, banks. So bank stocks are stocks that I have been watching. They've been trending up a bit, but I still think they're all such great values on the Canadian banks here. Getting starting yields of 4.5% for a high quality bank like TD with a 10 times price to earnings ratio. One that I own in another account is CIBC. CIBC here is trading close to a 52-week low. It's trading at a forward PE of 8 to 8.5, and it's yielding over 6% here. So this is one that I'm looking at. It looks like it ran a bit this week, but if I just look at it longer term, you can see it's still in the hole quite significantly in the past year. And their payout ratios are still really solid, only about 50-55% on the high side, and they've been increasing their dividends year over year. So I'm really confident in my banking positions that long term these will be great investments to make. And I think at these buy-in prices, these starting yields, given how often they increase their dividends, it's a spot that I'm looking at starting to build out even more than they currently are in my portfolio. Three banks that I own are CIBC, TD, and then I also own Scotiabank, which you may have seen at the top of my portfolio here. So Scotiabank's another one similar to CIBC. Get a nice starting yield over 6%. Have a PE forward looking under 10 times. So don't know what more you can ask for these kind of quality banks. Obviously, if a recession hits, if something major happens, the banks get hit hard. But I think they've proven over the last 50, 100 years that they'll always bounce back. So I'm surprised to see them in the doghouse to the extent that they are. And then lastly, a stock that I was looking at on my watch list this week was Diageo. Obviously didn't pull the trigger. Diageo is down 9% in the last year. They are, I believe, the world leader in liquor. So they own lots of like vodka brands, tequila brands, things like that. Very global company, mostly a European company is where it started, but they have a huge U.S. business, Africa, Latin America, Europe, obviously. They pay a 2.5% dividend, trading at about a 20 times PE, market cap, pretty big company there, $89 billion. So this is one that I've been doing some more research looking at. But to be honest, with Jameson going down, with Coca-Cola trending downwards, I thought I already have positions in these CPG companies, these consumer goods companies that I'm looking to build out. So just because those stocks have been going down, it's distracted me a bit from potentially adding a new one to the portfolio. But Diageo is one that I've been watching and I'll keep an eye on. So those are the stocks in my portfolio that I have been looking at over the last week, doing some buys on, considering some buys on, maybe looking to buy some of those stocks in the week ahead. But I actually had no sells from this week, didn't even sell any of my cash position to fund these. It all came from new capital coming into the account. Hope you guys like this video of me going through my portfolio and the changes in my portfolio from the last week. If you did, be sure to give this video a big thumbs up. And if you haven't yet, be sure to subscribe to the channel. I really do appreciate everyone who makes it to the end of these videos. Not too many people do, so thank you guys very much. If you did, be sure to let me know in the comments. Would love to say hi. I'll see you guys in the next one.